Yep. Okay, this is Rhonda Thomas for Financial Accounting. We're getting ready to do the final exam review in Cengage, chapters 11, 12, 13, 14. We're just about to do, we have two exercises from each of the four chapters as a review for the final. And then you can take the final on your own when you're ready. Just so you know, the final has 3 hour time limit. You'll get these 8 exercises, okay, and then you'll get 20 multiple choice questions for each of the 4 chapters. And I've got that information right here in our modules, what to do next. Okay, so we're going to be able to knock out this exam review, which is worth 50 points. And then you guys will do the exam on your own. And that's due this Saturday. And then we'll also have this project. And Wednesday, we'll go over the project. And I'm going to have videos out there of me doing a version myself. Okay, so having said that, let's get back to, and let me just double check if anybody else came in on Zoom. I think someone did. So let me look. Okay. Yeah. Okay. Cassie came in. Very good. Okay, Cassie. Wasn't sure if you had a chance to join us, but I'm glad you did. So, okay, I've got you down now. All right. We're going to issue bonds. We're going to issue bonds. To issue means to sell them. We're selling them to bring in capital so we can build our business, right? So Thompson Company produces and distributes semiconductors for use by computer manufacturers. Thomson issued $960,000 of 10-year 7% bonds on May 1st of the current year at face value with interest payable on May 1st and November 1st. The fiscal year of the company is the calendar year. Now, when I look at a bond, the first thing I want to do is draw a rectangle and put all that information in the rectangle because it helps me understand what all I need to know about the bond. Now they're saying that they issued the bonds at their face amount. So there's not a discount and not a premium on these bonds. All right. So I'm going to put this information down. So I've got $960,000 worth of bonds, and usually bonds are sold at $1,000 increments. So that's not a far fetch there. Okay, $960,000. What's the contract rate? The contract rate is 7%. Okay, so what does that mean? That means that every year we have to pay 7% to our bondholders, right? But because we pay it twice a year, okay, interest period, normally semi-annual, twice yearly. So, yep, it is semi-annual. So we're going to actually be paying half of the interest, which will be 3.5% every 6 months. Okay, so now I want to calculate the interest payment. The interest payment. So how do you do that? You use the face. Okay, so here we go. 960,000 times the coupon rate, which is 7%, or the contract rate. That's interest, 0.07. And then times 1/2, because we're making interest payments twice a year. Okay, so I'm going to calculate the interest payment. That's what I'm doing here. So that interest payment becomes, so let me type this, or let me put this in here. All right, so we take 960,000, which is the base, times 7% times 1 divided by 2. Okay, I've got $33,600. is how much interest is going to be paid every 6 months. Every 6 months. We can't just ignore it. Yep. So they're loaning us their 960,000, but we're going to pay them interest on May 1st and November 1st. Okay. Now the bond price, they didn't tell us what the bond price was, but they're selling at their face. Okay. So this particular bond has no discount or premium. And when that's the case, then it sells at its face, sells at face value. So once again, sell at face value. $960,000 is the amount we received and the amount our bondholder paid us, okay? So now we're going to put these in some T accounts now that we have all this information figured. It's always good to do this, to practice this, because you never know what they're going to ask you on some of these. So it's good to get used to finding out the information that you need. The reason I put all of this inside a rectangle, just to remind you, is the fact that this is a contract. And everything on this contract right here, see I put bond contract? By the way, that's also called an indenture. Okay, if you happen to see the word indenture in any of your questions, that is, indenture is another way of saying contract. Okay, so now we're going to get ready to put these into journal entries, right? And we've got some T accounts here. Okay, once again, the bond issuer is the seller, that's us, raising the capital, paying the interest, and paying back the bond at maturity. And this is a 10-year bond. Oh, that's another thing I forgot to do. Hang on a sec. Just so we know, we're going to be making 20 payments. Yep, that's 10 years times 2. So I'm going to put that in here so you'll know to figure that out when they ask you. So 10 years times 2 is 20 interest payments. So if we hang on to this bond for 10 years, we will make 20 interest payments. So that is the 10 years times 2. Okay, so equals 10 times 2. Just so you'll know why that 20 is there. That's the number of payments. That's the number of payments. So over the 10 years of this bond. All right. So the first one is May 1st. Okay, May 1st. You always put the face of the bond in a bonds payable. So I'm going to put 960,000 here. Okay, so I've got a credit here. So let's put bonds payable, 360,000. No, 960,000, sorry. Now, so sometimes you can exchange assets, like maybe you had a building, maybe you had some vehicles, maybe you had some inventory to bring in, or you swapped it, right? You swapped it. I'm not having you work any of those problems, but you can pay for things. You can pay for bonds and stocks with something other than cash sometimes, but we wanted cash, right? And it says that we received fiscal year. Okay, yes, for cash at their face value. So that means cash is going to go up. Okay, so let me see here. I got a cash account here. Okay, so I'm going to put cash here. So we want cash to go up because of what we just sold. Okay, so that's going to happen here. Okay. So you can check your work if you want. Where's mine at? Hang on just a second. It must. It doesn't? Okay, hang on. Hang on. I want to fix that. Just a minute. Sorry about that. I meant you to be able to check your work, so I must have hit the wrong button. So bear with me just a moment. If you'll go out of it, give me a chance and I'll fix it. Okay, let me fix this. Sorry about that. So I'm glad we're going through this so that I could see that I needed to fix this. So we will take care of it right now. So if you'll just exit. Okay. Should be able to get questions. Okay, you can take it. Oh, if you want to take it more than once, you can. Time allowed per take, printing, restrictions, grading. Okay. There it is, unlimited. Okay. Okay. All right, so now I'm going to go back in there. And if you'll go back in there as well, then we should have check your work. Well, I'm glad we were able to see that, because I sure didn't mean for that to happen. But at least it's fixable. At least it's fixable. I would have given anything to have checked my work back when I was learning this, because it really matters a lot. Okay. All right. So if you're back with me, hopefully you have the same problem. Mine came up the same. If you didn't, you might take just a minute or two to go through what you need to put down about your bond. But I think we're all going to sell a bond at its face. All right. So I always put the bonds payable in that liability first. So the face amount of the bond always goes in bonds payable. That's whether it sells at a discount, a premium, or it sells at its face. The bond payable always holds the face amount of the bond. Always, always. Okay. So, and then we got cash for it, because we're trying to expand our business. Okay. Okay. And that was May 1st. Now we're getting ready to pay the interest. And remember, when we went through all the things about this bond, I encouraged you to go ahead and calculate your interest payment, right? So since this one has been issued at face, we don't have to worry about amortizing the discount or the premium. All right. My problem was calculated at the face value of my bond, of the bond, times the contract rate here on the bond, which is 7%. And then we're going to take it times a half, because we are paying interest twice a year. Semi-annual interest is the most common bond interest payment that there is. And I went ahead and calculated it. So we've got to send them this payment. When we send them their interest payment, it's going to go down in cash how much we calculated that payment to be. Now, once again, because there's no discount or premium that we have to make go down every time we pay interest, interest expense is simply $33,600. So we didn't have to mess with the discount or the premium, right? So that is paying that. All right. So this is going to be interest expense, 33,600, and cash goes down because we're sending them a check. Okay, sending them a check. All right, so now it's now it's December 31st. Okay, it's December 31st. And that means we just paid interest November 1st. So we have November, December. We have 2 months, 2 months to account for the interest, right? 2 months. So let me move this down. All right, so let's do our interest payment again. And this time, okay, so what we're going to do, if we pay 33,000, so interest payment, write that down or put it down somewhere. Okay, interest payment is my $33,600, I believe. Yes. And then since that's half a year, you can divide this by 6 months, and then, yeah, you can divide it by 6 months and then take it times 2. That's how I would do it. So we're going to accrue. Accrue means accrue 2 months of interest for the month of November and December. Okay. So accrue 2 months of interest expense for the year end on December 31st. Okay, that's what they're trying to do. So if this is the interest payment, we're going to, so how much is it per month? So per month, the interest payment, we're going to take that amount of interest and divide it by 6. Okay, there it is, $5,600. And then we're going to take this amount times 2. Okay, so now let's see here. 5,600 times 2 months. So here should be the answer. So let's take this times 2. So I've got $11,200. So this is not making the next payment, but it is accruing the interest for the 2 months left in the year. Okay, 2 months of the year left. We need to put interest expense in this year. All right, so the amount of interest, once again, if you know your interest payment every 6 months, you would divide that interest payment per month and then take it times 2. All right, so that sometimes is a little bit tricky when you think about it, but let's see if I got it right. Now, we're not paying the interest, but we are accruing the interest expense. So $11,200 is going in interest expense, right? For the end of the year, $11,200. And now where is the other one going to go? It's going to go in interest expense payable or interest payable, whichever. Interest payable is what it is. Interest payable. Okay, so this is going to have a credit balance, and it's going to get $11,200 as well. Okay, $11,200 as well. And that's going to stay in that payable until our next pay date, or the interest payment date, which is May 1st, right? May 1st, right? We just set aside basically interest and made sure that the interest expense is showing up in the year that the year it happened, and that is accruing it. Accruing it means recognizing the expense even though we haven't made the next interest payment yet. Every month that our business is in business, there's going to be $5,600 worth of interest that we owe for that month. Yep. Okay, so it's good to break it down into all these different pieces. Okay, just a second here. So once again, $5,600 is how much mine is per month and then I took it times 2. And that's how I ended up with the interest payable. So if you want to know, I'm just going to show you one other thing. So let's pretend now, just a second. You say, well, okay, so now let me so I've got this payable sitting here, right? So let's say it's the new year. Okay, it's the new year. It's May 1st. Let's say that it's time to send another interest payment. What we're going to do is we're going to send it out in cash. Okay, we're going to send it out in cash with a credit. We're going to debit this interest payable because we've already recognized 1 or 2 months worth of interest from the year before. And then the last is going to be a debit for 4 months of interest. Okay, so that's how you would get it out of the payable. Okay, and then this is going to be equals 4 times $5,600. Whoops, 4 times 5,600. Okay, so that would recognize the remaining 4 months, which would be January through April, and we have to send the payment on May 1st. All right, so just so you know, when we set that interest aside at the end of the year on December 31st, we put it in as a payable. Now on May 1st, we're sending out the payment. Okay, so May 1st. And then let me just, we'll move this down. Okay, so there's the 2 interest payments. This was on November 1st. Okay, so we've made 2 payments of interest, but that one we had to accrue. This was on December. Okay, so let me put these dates here so you could see it. And then this was the payment on November 1st. And and this is the issuing the bonds on May 1st. This is December 31st. And then, okay, so that should be okay. All right, but I wanted to show you how we would end up paying it if we, for the next year, okay, how we would do the next interest payment when we already have 2 months worth of interest sitting there in interest payable. Okay, everybody good with this? Does anybody have any questions out there in Zoom land? No? Okay, let's move on. We have one more to do here, and we're going to pretty much treat it similarly than what we just did. Okay, so this is going to be another bond, but this time the bond is going to be issued at a discount. Okay, so let me pull out the stuff out of here so that we don't get confused. But my best recommendation is when these two, be sure to write down all the particulars of the bond contract. Okay, so I think I have a place to do that now. Okay, my bond is 22,100,000. Okay, my bond is 22,100,000. It's a 5-year bond. Okay, and it's issued at 10%. The contract rate is 10%. We have semi-annual interest, which means the interest payments are paid twice a year. Semi-annual, which is semi times 5, is actually 10 payments we're going to be making of interest, right? Now let's get ready to calculate the interest that we need to be paying. Okay, so let's see here. We take the face value, 22,100,000 times 10%. Wow, That's a good paying bond. Times a half. That's how we're going to calculate the interest payment. Okay, let me put my commas in here. I hate numbers. I hate long numbers without commas. It makes it very difficult to read. Okay, there, that's much better. Okay, so now let's do the math here. Okay, we're going to take 22,100,000 times 10% times 1 divided by 2. All right, so it looks to me like our interest payment for this problem is 1,105,000. Wow. And we got to pay that twice a year. Okay, so we got to make sure we have the cash to do that. All right. Now, what's going on? All right, so let's see how much it's selling for. There's the cash we received. That's less than its face. And that's what we would expect because this bond is selling at a discount. Selling at a discount. So let's go here and put how much cash did we get? Or better yet, let's start with the bond payable. Okay, the bond payable. Mine is 22,100,000. So be sure to put the face value in your bond payable. That's a must. Okay, that's a must. So, okay, let me make this a little wider so you can see it. Maybe. Boy. I think I'm going to start over on this one. Okay. 22,100,000. Nope. There we go. Okay. Now, how much cash did we get? Go and find. You're going to have cash that's below the face value because it's selling at a discount. So put your cash in, $21,267.84. Okay. All right. And then that means that there is a debit we need between the difference between these two. So there's the bond payable, which is the liability that you're going to put down, and then the cash that came in, and then the difference. So I'm going to calculate this discount here. Okay, I'm actually going to calculate it up here above the T account, just so that I know how much it is. Right? So if I take the face and subtract the cash that we received, okay, so there is the discount. There it is. So now we can always remember what it is in case we start messing around with the T account. Bond amount. And that's going to get reduced over 10 years. Okay, so here's my discount. And now we're ready to put this in. So we've got a debit to cash, a debit to discount on bonds payable, and a credit to the bonds payable account. All right, so here we go. Cash. And they tell you at the end of this problem how much cash you got for selling the bond. Okay, $21,267.84. Put the bond payable at the bottom. That's usually the best strategy. Okay, and then that discount goes in the middle. And remember, a discount is always a debit. Always, because the cash that we received plus some other debit has to equal the bond that we have sold. Okay, the face of the bond we've sold. So this is going to be discount on bonds payable for $832,916. Okay, let's check our work. Make sure we're on the right track. Uh-oh, what did I do? 21,000, and I've got it in as a credit. 21,267.084. Let me try this again. Okay. Hmm. Bond. Oh. I just did what I said not to do. Put the bond payable in here, guys. Yep, 22,100. 22,100,000. There we go. My goodness. I'm just not used to messing with that many zeros. Good grief. 22,100,000. There's what we want. Always put your face value in your bond payable. So I wasn't listening to my own instructions. Okay, so just so we know, let's take our bond discount and we're going to amortize it. We're going to amortize it over 10 years. Why? Because the bond is for 5 years and we're going to be making interest payments twice a year. So we're going to amortize or use straight line amortization, okay, for the amount that we amortize it. So we're going to take the amount of the discount and divide by 10. Okay, when I divide by 10, this is how much the discount will be amortized every time I make an interest payment. Okay, so let's go ahead now. It says first semi-annual interest payment. Well, I calculated my interest payment up here. It's $33,600. Okay, $33,600. Let me move this over. Okay. So once again, we're selling this bond at a discount. Why? Because our bond contract rate of interest is 7%, but the market rate, okay, the market rate right now, according to my problem, let me go back and read it now. The market rate is what? 11%. My bond is paying 10%, but the market has other financial tools selling at 11%. So we have to sell our financial instrument at less than its face to be attractive. So I'm going to put 11% here. And notice that's outside of the rectangle because that's in the market. It's also known as the effective rate or the economy rate. And once again, it's higher, right? So a bond is sold at a discount when the coupon rate, which is the contract rate, which is the 10%, yeah, is smaller than the 11%. Okay, when you have a contract rate that's smaller than the 11%, the bond will sell at a discount. Price is below the face value because market rate earns more. Okay, that's the reason why. All right, so let's go ahead now and get ready to record an interest payment. We calculated interest. Go down here. Okay, we calculated interest at 100 or 1,105,000. By the way, I didn't put my bond price down. Let me put it down so that we know. Okay, and then we're going to amortize the discount. Okay, the discount is this much here. And when we amortize it over 10 years, so 832, 916 divided by 10. That's called straight line amortization. Okay, we're going to take this number and divide by 10. Every time we make a payment, we're going to make that discount go down by 83,292. Okay, now we're ready to make the payment of interest. Okay, the interest payment that I've got is 1,105,000. That's going to make cash go down. Okay, cash is going to go down by the amount of the interest payment, whatever you calculated it to be. Okay, you have to back into interest expense. I'm sorry, but that's how you have to do it. Okay, we're going to make the discount amortize by 83,292, which is what we just calculated. That is 1/10 of the discount in total. So we've got this happening here, right? We have to add these two together to get our interest expense. So let's add them together. All right. So when you have a bond discount, you actually, or when you've sold a bond at a discount, you'll actually pay more interest expense. Okay. Now, so how much? 1,188,292. That's the calculated amount of interest, but the interest payment that we owe the bondholder is exactly the cash that we send them. And then to make the discount go down, we had to credit the discount on bonds payable. Okay, we had to credit it for 83,292. Okay. Whew. Okay, that was the first semi-annual payment. They didn't tell us what days those semi-annual payments are happening. So that's okay. We'll just keep going. Now we're going to do the second one. Well, what's cool about amortizing a discount or a premium, that same entry that we just did for the first interest payment will now be the second interest payment. So once again, we want to just make cash go down by 1,105,000. We make the discount go down 83,292, and that same expense amount, interest expense, 1,188,292. Okay, so all you have to do is repeat this, which is kind of nice. And that if we hold on to the bond to maturity, we'll have to be making these payments every 6 months, and over 5 years we'll have made 10 of these. All right, so then the discount goes down by straight line, and then down goes cash for the amount that we calculated is the bond payment of interest. Okay, and when this whole thing is said and done in 5 years, we have to pay them back $2,100,000. We got to pay that back. Woo! On top of the interest. Yeah. So that's kind of how that works. So first question, or the question B, determine the amount of the bond interest expense for the first year. So they didn't tell us what dates this happened. First semi-annual interest payment and the second semi-annual interest payment. I think we are to assume that both of these happened in the same year. Oh, on the first day of its fiscal year, yes. So these two interest payments, these two amounts of interest expense actually happened within the first year. So I'm going to do a total here of both of these, so we know how much is in interest expense. Okay, so interest expense is the amount of both of those, right? So 2,376,584. You got to add those together. Okay, you got to add them together because they both happened in the first year. Now, if we would have sold that bond in the middle of like on July 1st, right? July 1st, there's 6 months left in the year. We would have only had one interest payment for that year, right? But both of these happened within the first year of issuing that bond. So I'm going to put first year payment, first year number 1. I'm going to put first year number 2. Okay, because I know sometimes we get different problems that depends on when you sell the bond, when your payment dates are going to be. All right. So here's how it goes. Why was the company able to issue the bonds for only $21,267,084 rather than for the face amount. Well, if you look at the rules I've got here somewhere, there it is. There it is. So if your market rate is smaller than the market rate, if your coupon rate is smaller than the market rate, I got to get the right words out of my mouth. If the contract rate is smaller than the market rate, then we have to make our bond more attractive by selling it at a discount. The market rate of interest is greater than the contract rate of interest. Therefore, investors are not willing to pay the full face amount of the bonds because they can go invest their money in something that pays 11%, right? You'd rather invest your money into something that pays 11% than 10%. So we got to make the bond attractive. Okay, that's it for chapter 11 as far as working bonds. Let's move on now to stocks. Okay, I am going to go get my stock page here, so bear with me a minute. So we just did the two ones for chapter 11. I'm going to go get my chapter 12 now and bring it in, and it should work out okay. Give me just a second. I will open that. Okay, I want this one. And we'll just copy it, move it, and copy it. Okay, create a copy and okay, and we want to put it in this one. Yep. Okay, so now I've got that over here, so I can shut that now, no problem. Okay, very good. Okay, now we're going to issue stock. Okay, when we issue stock, we are actually selling equity. We're selling an investment into our company, kind of like selling a bond, but we don't have to pay it back. Okay, bonds we have to pay back. So if you don't mind, extra owners, this may be the only way to do it. Okay, maybe you can't borrow enough. Maybe you don't have a good enough credit rating, or maybe you're brand new to the industry and you can't do the loans. You're going to have to do equity investments instead. Okay, so we're talking about shares of stock. Just to remind you, we're going to be looking at equity accounts quite a bit here. Remember, equity accounts have a credit normal balance. And just to refresh your memory, stockholders' equity basically is made up of two kinds of equity. One's called paid-in capital. That's all the stocks. Okay, all the stock. In fact, I'll put paid-in capital beside. I'm going to put preferred stock and paid-in capital. See, even the words paid-in capital is in the title. Paid-in capital in excess of par, and this is for preferred stock. Okay, so that's those. There's two of them. There's actually five possible paid-in capital accounts usually in a business. Okay, so I'm trying to help you remember the names of them in case you get any test questions. So once again, there's preferred stock, paid-in capital in excess of par, preferred stock. Let me give you the titles of these here just a second. Insert. Because I had a hard time with this. We also, all businesses have that are incorporated have common stock. They may not have preferred. Okay. And not all businesses sell their stock publicly either. Okay. So in excess of par, and this is for common stock. And then the fifth account that you could have in paid-in capital is paid in capital from sale of treasury stock. From sale of treasury stock. Okay, so I just kind of want to bring this to your attention again, because we didn't cover this in as we covered this pretty quickly. Okay, so let's go ahead and see what we got here. We've got a common stock account with a credit balance. We've got paid in excess of par, common stock with a credit balance. Notice these two go hand in hand together. Okay, they go hand in hand. So just a second here. I'm going to make something to make these have the same color. Okay, so I want this to be a certain color. Just a minute. We'll make common stock blue. So we'll make this blue also. These go together. Okay, those two go together. Preferred stock is on its own with its own paid in capital in excess of par account. So we'll make this one green. And then its paid in capital in excess of par is right here. So I'm going to make it green. Okay, so once again, blue goes with blue and green goes with green. Okay, so it says on January 22nd, okay, let me find a spot here. Okay, so I need to be able to make some calculations here. And it's usually good to do it this way. Okay, and we're ready to go. Okay, so dividends. Remember, dividends are share or payments of earnings to shareholders. It can be to preferred or common. Just depends on what they have. Not all businesses have preferred. All right, so here's what I'm going to put. Okay, January 22nd. What's going on here? So we issued for cash. Okay, so we got cash for 180,000 shares. Shares of no par common stock. You say, what do I do with that? I thought we had to have a par. Well, you just don't have a par. Okay, you don't. So here's how it's going to go. So this is 180,000 shares of common stock. Okay, and at $7. So the price was $7. Okay, $7 a share. Okay, and we're going to make that into a dollar so that we know that has something to do with, yep. All right. So how much did we just raise in capital? Right? We take the 180,000 shares times the $7 no par price, and we just raised 1,260,000 for our company. Okay, so now let's put this into a journal entry. And I'm going to make this a little bit smaller so we can see this better. And I'm going to get rid of the decimals there. All right, so here's how this is going to work. We just raised 1,260,000, and we need a cash account also. So do I have anything over here? Yes. I think I have a cash account up here somewhere. I should have. Those are cash dividends. Cash dividends is not a cash account. Okay, so let me make a cash account right here. Okay, so how much cash? 1,260,000 just came in cash. Okay, then we're going to put that 1,260,000 in common stock. Okay, so here we are. It gets a credit. Did I put that on the right side? Let me make sure I did. Yes. Okay, so we debited cash for 1,260,000. We're going to credit common stock for the same amount. Okay, 1,260,000. And above the T account, I'm going to put what's going on in here, right? We got 180,000 shares right now, and we paid $7 for them. Okay, I like to keep that up above the T account just so that I can remember how much that is, right? So once again, common stock. We sold the common stock. We sold that to the secondary market. All right, so let's make the journal entry. So up goes cash. If I figured things right, 180 shares times 180,000 shares times 7. So we got 1,260,000 in cash, and we're making common stock go up. Now we don't have paid in excess of par because there is no par, right? It was just $7. So we can't make up information that they don't give us. Okay, 1,260,000. One more zero. Okay. Okay, that was on January 22nd. Let's see if we're right. Okay, looks like we're good. Okay, what's the next date? The next date is February 14th. And we sold some more, this time preferred stock, right? So we received cash, and we're selling 55,000 par value stock. The par is $40. Okay, now be careful. So shares of preferred stock, and I'm going to put down underneath the information about that preferred stock. So the par is 40. Okay, par is 40. And we sold them for okay, we sold them at par. That's fine. Price is par. So sometimes you'll have a different price than par, and that'll be in excess of. So let me put that amount down. It just so happens that the $40 is par, and it's also the price. So yes, you can do that. Okay, and now let's do the math here. So if we sold 55,000 shares at a price of $40 a piece, then we received 2,200,000 in cash, and we're going to record. All right, so that's the cash that just came in. So we're going to record that there. Okay. And then we've got 55,000. Well, that's also, if we had excess of par, we would need another entry. So the fact that we paid $40 for our $40 par stock is a little unusual, but that's okay. And then we're going to get that same number. We're going to get 55,000 times the par, because that's how much is going to go in the preferred stock. Okay, preferred stock. Okay. Keep always going the wrong direction. All right. So here comes cash, which is over here. So we just did, so now we're doing another one, 2,200,000. Wow. Okay. And then we're going to put that in preferred stock. Now be careful. There's no excess right now. So it's just what we have here. Okay. So that equals this. Okay. So preferred stock. And then I'm going to put the information in about it, 2,200,000. Okay. 2,200,000. I think we're good there. Let's check it. Okay, right above the preferred stock, once again, I like to label what's going on with what we just bought, right? So what did we just buy? So the par is $40. We want to keep track of that. And we sold 55,000 shares, or we issued 55,000 shares. There we have it. Okay. All right. Now, oh, by the way, that preferred stock, when we wrote that down, I want to say that it's 3%. 3%. You say, what does that mean? That's the amount of their dividend, 3% preferred stock. Okay. So what does that mean? That means that that's a dividend. That's the preference to dividends. Okay. We can calculate that. Preference to dividends. Preferred receiving dividends. They get their dividends first, if there are any. Okay, so let's do the math. So you take the 3% times the par value. All right, and when you do that, that is going to pay $1.20 a share. Does everybody see that? $1.20 a share, $1.20 share. So this is going to be dividends. Dividends, if they sell any, I'm sorry, if they send out any dividends, dividends per preferred share. All right, so I put all that down when that transaction happened, right? So this last one then is on August 30th. Okay, so August 30th now. They're going to do dividends, I believe. Yes, issued cash. I think it should say cash dividend. Wait, no. Issued for cash. Oh, we're just selling more. We're just selling more of the preferred stock. That's okay. So we're going to receive cash. We're not doing dividends right now. Received cash. All right. And we're selling an additional 28,000 shares. Okay. Shares of preferred stock. And its par, or no, its price is $45. So this is going to tell us how much cash we received. Okay. Okay, so here's the total amount of cash for that last sale of more preferred stock. 28,000 shares times the price of $45. So that's the cash coming in. Okay, let's go ahead and do the rest now. We did 28,000 shares. We need to take it times its par. Okay, par is 40. So we just made a little extra, right? So if we take 28,000 times $40, we get 1,120,000. So the rest goes in excess of par. Okay, so this is excess of par. And that's $5. Okay, $5. And then you take 28 times 5, and then that will balance. Okay, that will balance. There's the extra paid in capital that we just received because our shares sold above in excess of par. Okay, in excess of par. Yeah, I'm going to leave those in cents there. You can see them. All right, so cash came in, right, for the 28,000 shares that we sold at 45. So we got 1,260,000. Okay, and then we have to record the preferred stock. So there's 28,000 shares at its par. 1 million, that goes over on the credit side, 1,120,000. Okay, and then the rest goes in paid in capital in excess of par preferred stock. Be careful, don't pick the common stock one. Okay, so let's see if we're right. And I missed this. I think we got it now. Yeah. Okay, there we have it. So once again, when you sell it at just its par, then the cash we received equals what we put in those equity accounts, right? But when we sell shares for more than the par, we got to do a little more to it. So I didn't finish these in the T accounts, and I'm going to. So once again, 2,200,000 came in. We sold an additional 28,000 shares. Okay, so now this is preferred. So it's over here. All right, so now we have 55,000 shares plus 28. I want to know how many shares. 55,000 plus the amount we just sold on August 30th. Okay, so we have 83,000 shares, and we have an additional 1,120,000 in preferred stock, and then the credit also goes 140,000. That's paid in capital. What's the point of selling stock? To raise capital. If you can sell a share for $45 instead of just its par, that's great. That means that your stock is in demand even above its par. Okay, it's priced out. The market price gets determined by the economy, basically. Okay, so that is a mixture of selling some common stock at par. Well, no, it said it was no par, but you've got to have an amount to put in the accounts. So we got cash, and we got cash, and we got cash. All of these we issued stock. We issued common stock, which has no par. We issued preferred stock, which has a par of 40. And then we sold more preferred stock at a price of 45 so that we would have extra paid in capital in this particular transaction. So hopefully you're seeing that. Remember, these are all equity accounts except for the cash. And that means that a credit balance will be needed. Okay. Second one, then, we're going to work on treasury stock. Okay, treasury stock. So, okay, remember treasury stock, here's what it is. It's stock that we buy back. So treasury stock is once we've sold our stock for the first time when we issued it, that's an initial public offering, right? And then we sell stock anytime we want to directly from the company. But once it's out there, we're not going to get anything else from that stock. But we can buy some of our own shares back, like we are a secondary market investor just like anybody else. Okay, so this is called reacquired. You're purchasing your own stock back so that you can participate in the profits and possibly losses if necessary. Okay, so let's see here if I can get to this. Treasury stock, yes. All right, so once again, it's called reacquired stock. Company invests in secondary market of their own shares. Yep. Once again, the primary market shares are sold directly from the company to the investor, but the secondary market stock shares are bought and sold between investors. So if you hear those words or see those words, that's what they mean. So on May 27th, we reacquired 79,000 shares of our own common stock at $8 a share. Okay, so put down how many shares you're buying and the price that you paid for it, $8 a share. Okay, so I've got to put 79,000 times 8, right? 79,000 times 8 is what 632,000 is. Okay, now we're going to show treasury stock is $632,000. And we paid that in cash. Okay, we paid it in cash. So 632,000 is that's how we start a treasury stock account. Okay. I'm going to put the information above the treasury stock so we can keep track of what we did here. So once again, we bought our own shares, 79,000 times $8. Okay, hang on. Let me get this out of here because we're not quite ready for that. Okay, so debit to treasury stock. Treasury stock is an equity account, but it's an equity account that has a debit normal balance. So this is odd. Okay, this is odd to have a debit normal balance, but that's how you have to treat treasury stock. Treasury stock is subtracted from equity. We can't own our own shares and call it equity. We have to separate it out. So let's put the amount that we got, 632,000. No, that's how much we paid. We bought the stock. Okay, so we invested in ourselves. Now, the reason we invest in ourselves is we hope to be able to sell these treasury shares for more than $8 a share. Okay, so once again, we bought 79,000 shares at $8 each. We hope to sell them for more than $8 a share. Okay? Excuse me, I've got the hiccups. Let me take a drink. Okay. Now it's August 3rd, right? It says August 3rd, Hydro Clothing sold 52,000 shares of those reacquired treasury stock at $11 a share. Yep. So now we're selling some of them, and that's what we had planned. When the market, if the market increased, right? So we're selling 52,000 at 11. So 52,000 at 11 means that cash came in for 572,000. So I'm going to put that here. 572,000. Cash came in. Okay. Now what? Well, now let's do the math here. How many shares did we just sell? 52,000. Yep. So we're going to subtract 52,000 from the number of shares that we just put in here. Okay. So just for fun, let's see how many shares are left after we have 27,000 remaining. All right. So we've got to do a calculation here. We've got to take 52,000 times $8 a share. That has to come out of the treasury stock account. Okay, it has to come out of it, and it can only come out of it at its cost. Nothing else, or we'll lose track of how many shares we have. So we just made $3 profit on each treasury share, right? Yep. How many did we sell? 52,000 times 3. And that's going to be your paid in capital paid in capital from treasury stock. Okay, so let's go ahead and take care of this third one, right? So the third one makes treasury stock go down 52,000 times 8. 52,000 times 8. And I'm not going to do that in here. I've got it up above here. 52,000 times 8 is 416,000. So that's gone. Okay, that's out. And then the extra paid in capital is 156,000, if I got that right. Yes. 156,000. So we just made extra capital, extra paid in capital of the amount that's on top of what. So we bought those shares for 8. We're selling them for $11 a piece. And that's what we want to happen. We want paid in capital from sale of treasury stock when we sell these. Okay. So that's treasury stock going down. And it is 416,000. And the extra is paid in capital from treasury stock, 156,000. So once again, when you get finished with these, I just have a hard time with zeros when I'm filming because I'm not counting my zeros very good. We got 572,000. Let me see if I got that right. 52,000. Yeah, 52,000 times 11. Okay. All right, here comes the third sale of treasury stock. This is now on November 14th. Now we're going to sell the remaining shares. Hey, it's good to know, right? How many we have remaining. Otherwise, we wouldn't know. So, okay, so one more time. This sold on August 3rd. August 3rd, and then we want November 14th. November 14th for the rest. Okay, the rest is 27,000 shares. So sold remaining 27,000 shares of treasury stock, but we sold them at $6 a share. Uh-oh. So that's not the best scenario for us because we paid $8 a share. Okay, so I've got to do the math here. So it is 27,000 times $6 a share. Okay, so you'd have to figure out how many shares you have left after that first sale of treasury stock. Okay, then once again, we would take 27,000 times 8 because we got to take it out of that treasury stock account. So 27,000 times 8. Yep, there it is. Okay, so it's going to go down 216,000. Okay, we are going to show the cash that we just brought in of 162,000. 162,000. And the rest goes in. Yep, it's going in as a debit this time because we sold it below what it cost us. Yep. So now we need 27,000 times 2 here. 27,000 times 2. 54,000. It goes on the debit side. See, I thought you said paid in capital is always a credit. It depends. This was a loss on the sale of treasury stock, right? The other one before was profit. So when we sold them, cash came in. How much cash? 162,000 came in. Okay, and we're going to credit treasury stock. Okay, treasury stock 216,000, and then the rest. I messed up. Make treasury stock on the bottom. Yep. Bring that number down. There, that's fine. Now we want the paid in capital account in the middle. Okay, we want treasury stock to go down with a credit. The one in the middle is paid in capital from sale of treasury stock. So this actually is going to go on this side. It's going to go on as a debit. The debit is 54,000. So that's the loss that we took when we turned around and sold it for $6 a share. Okay. Okay. Are you heading out?
Yeah.
That's okay. I'm videoing this so you can watch the rest if you need to. If you don't need to, all the better for you. Okay, guys, I'm going to keep going. Now we're ready to go to the cash flow statement. Okay, cash flow statement is the fourth required financial statement after the income statement, the statement of stockholders' equity, and the balance sheet. Cash flow statement is fourth one. We'll see you later. Thanks for coming in. Okay, I'm going to open up my spreadsheet for cash flow. I need chapters 13 and 14. And I'll go get this. I'll just go ahead and get 13 and 14 while I'm thinking about it. 13 is right there. All right, so 13, I want this intro tab copied and moved into that new book. Yeah. Create a copy. Okay. So now this is going to be chapter 13. Okay, bear with me a minute. I'll just go grab chapter 14 while I'm thinking of it. Then we won't have to do that again. That is going to be, okay. Okay, that should be chapter 13. I thought I changed that. Chapter 13. Nope. Wait a damn minute. Yeah, chapter 13. And this should be chapter 14. Okay. Here we go. Cash flow statement. Okay, remember the statement of cash flows here's an example real quick. Let's just take a minute and look at one again to refresh our memory. What's the purpose of a cash flow statement? It is to reconcile the change in cash, right? So what is the very last item on the cash flow statement? It's the ending balance of cash. The one right above it is the beginning balance of cash. And then you always know what your cash flow has to balance to, because the difference between 26,000 and 97,500 is a positive number of 71,500 going up. Okay, and then we have three sections. We have an operating section, which we're going to use indirect method for that. And then we're going to use the direct method for the investing and the financing. Okay, so this first question is talking about this recipe up here for the operating section of the cash flow statement. So we always start with net income. Okay, now they're giving that to us. If we didn't get it this way, they would have had to either give us the amounts in retained earnings or something, right? So indirect method, and I want to put net income here of 447,000. Okay, what do we do next? Let's remind ourselves of the formula, and here it is. Here it is. So we're going to take net income and we're going to make a series of adjustments. And sometimes finding those adjustments can be a little bit of a challenge, but most businesses have an automatic amount of depreciation. So depreciation will almost always be a given in a problem like this. So they said depreciation is 72,500. What do we do with it? You add it. You add it. Okay, so depreciation. Okay, and my depreciation on my is 72,500. We're going to add that back. We're going to look for amortization. They don't have any amortization. Okay, then we're going to look for a loss or a gain. Yes, we do have a loss of 21,800. So this is going to be loss on disposal. And what do we do with the loss? We add it back, 21,800. Okay, so let me go down here. I'm going to put 0. This is going to be a loss. Okay, loss on sale of investments. And what do we do with a loss? We add it back. Loss on disposal of income. So when you disposal of equipment, sorry, I can't even read here. All right, loss on equipment disposal. That's fine. All right, so loss on, okay, we're going to add it back. Okay, so we're going to add it. Okay, so how much is it? Loss on disposal of equipment, 21,800. Oop. Oh, there is no amortization. It's zero. Here's the one we want. Okay, so let's see how we're doing here. Okay, so loss on disposal of equipment, 21,800. Then we have to evaluate current assets and current liabilities. And here's where the difficulty can be. Okay, so I need to move this down just a little bit. Okay, so we have an increase in accounts receivable. Okay, so current assets, liabilities. Okay, so this is an increase in accounts receivable. Okay, remember an increase in accounts receivable, we deduct the change. Yeah, deduct change, deduct increase. Okay, let's see here, deduct increase. Okay, deduct increase. They gave us that increase, so we are going to deduct it. Okay, so then the other one is a liability, but we've got an increase here too. So increase in accounts payable. Now we add the increase because it's the opposite of an asset. So we add the increase of 5,000. All right. So once again, increase in accounts receivable. We're going to put that in as a negative. And by the way, we add the loss. Okay, losses get added back, gains get subtracted. Losses get added back, gains get subtracted. So we want to make sure we're following the rules here. So negative 13,100. And then we had an increase in accounts payable, and we add that number. Okay, if my calculations are correct, let me see. Uh-oh, hang on. Something's not right. Okay, net income, 447,000. My depreciation is 72,500. Yeah, that's going to make a difference. My loss is 21,800, so we add it back. Then we had an increase in accounts receivable. We will deduct the increase. And then we had an increase in accounts payable. We add the increase. So I believe it should be net cash flows from operating activities. Now remember, this is just the first section of the cash flow statement. First section, right? Remember, there's two more sections to go. Investing and financing. So far, our cash account has gone up by 533,200 is how much just this section caused cash to go up. Okay, so we want to make sure we're catching on to that. All right, let's go see what else we got. Okay, I want you to decide how this will affect the cash flow statement. Now, it may not be completely straightforward. You may have to think about it a minute. Okay, you may have to think about it a minute, but we want to know what the effect is going to be, whether it's going to cause cash to go up or down, an increase or a decrease, or a payment or a receipt. Receipt makes it go up, cash payment makes it go down. Okay, so hang on a minute. I think I have one of these that I can put in here. So if you'll bear with me a minute, let me go back to my chapter 13, I believe. Yeah. No. We want chapter 12. Just a second. We want chapter 12 again. Sorry. We want chapter 12. Financial accounting. Okay. I'm just going to go find this one. 12. Nope. It's 13. Chapter 13 is our cash flow statement account. All right. So now I want this one. So let me see where I'm at here. I'll bring this in. Here it is. Here it is. Here it is. This will help us a little bit. Okay, this is what I would do then if you're going to. Okay, it's the effects of the cash flow statement. So let's see if we can make this work here. All right. What section? Oh no. Okay, we're also going to put what section it is. All right, so and we want to do, is it a payment or, okay, so let me move these over. Let me do this. Okay, so this is the effect. So I'm going to do a little more than this. Okay, this is the effect. So it's either going to be cash payment or cash receipt. And then this one's going to be section, even though they're not making you do it. And then here's for how much it'll cause. And we may have to do a little calculation here. All right. So the first one says A, state the effect. Is it a cash receipt or a cash payment? And the amount for each of the following transactions considered individually on cash flow. So if you retire a bond, okay, that means you're paying the bond back. Yep. You're paying the bond back. That's going to be a cash payment. Okay, how much? Okay, there was $5,100. Okay, so here's how we retired it. It says, how much did we retire it for? 530,000. Okay, that's the cash. Yes, there's some other stuff. So the bonds actually, the bond payable was 510,000, and then there was the remainder of the discount. But when it comes down to it, the cash that we paid to retire those bonds is 530,000. Let's give it a try. Okay, so however much, remember this is the cash flow statement. So anything that affects cash and how much sometimes is not as easy as it sounds. All right. All right. Now we have B, sold. Okay. When you sell something, cash is going to come in. So this is a cash receipt. Okay. And when you sell shares, it's always financing. Okay. We're selling 25,000 shares at $25. Wait, no, at 58. Be careful. 25,000 at 58. Okay. We don't have to worry about the par and the common stock credit amount. We're just worrying about the cash right now. So we're looking at 25,000 times 58. So it should be, this is going to cause cash to go up. In what section? The financing section. Anything to do with stocks, dividends, anything to do with treasury stock is going down there. Okay. So let's check it. We're okay. Sold equipment with the book value of 57,900. How much did you sell it for? 83,400. So that is, so we're selling, we're getting a cash receipt. That is going to be investing in 83,400. Okay, that is a piece of equipment. And the book value tells us how much we had yet to depreciate. And they're not asking for it here, but there's always a chance that we would get, see, we're selling it for more than its book value, so we're going to have a gain there. But we're not going to worry about that. That's not what they're asking. So now we're receiving cash again because we're selling a piece of equipment. We sold it for 83,400. Okay. Purchase land for 329,000. So purchasing is cash payment. Okay. Yep. And that's going to go in investing. Purchased land, purchased building. Yep. Those are both going to go in investing. Okay. So it says for 329,000. So down went cash. So that's a cash payment. Okay. Cash payment. Thanks for hanging in there, Cassie and Oscar. If you can't, I will finish and post this. All right. Okay. E, purchased a building by paying $86,000 in cash. Okay. Well, the rest of it was mortgaged, but all we're going to report on this cash flow statement is what effect all of these had and how much on cash. All right. So we made an investment, down payment, sorry, of 86,000 on this. So down goes cash, but not all of it because we put the rest on a mortgage. Okay. We got three more. Sold a new issue of bonds at 460,000 at 97. Okay. Pay attention to this, because I don't know if I covered this very well. We're selling a bond at 97. Okay, when you sell a bond, that's in the financing section. Cash is going to be received. So I'm going to put cash receipt. Okay, now we're going to calculate how much. So you put the amount of the bond down. So 460,000 at 97. So we've got to calculate that in the box. Okay, so that is going to be 460,000 at 97. Okay, so looks like we've got, all right, and sold. When you sell, cash comes in. Okay, so it looks like 446,200. That's 97% of the face. So this bond is selling at a discount, by the way. This is selling at a discount. And when you see the bond price quoted like this, if it was 101, it would be selling more than its face. If it, so it just depends on what that says. All right, so let's check that one. All right, two more. Purchased 4,100 shares of $20 common stock as treasury stock at $39 a share. Now be careful. be careful. This is a cash payment because we're buying our shares, but we've got to put it in cash payment, and it's in the financing section. Did I do this one? Hang on. Oh, what was this one? Oh, this is a building. This is investing. Okay, sorry about that. Even though they didn't ask what section I am to help you see that. All right, now we're on G, cash payment, and we bought treasury shares. How many? We bought 4,100 shares at a price. Now be careful, we don't care about the par. We only care about the price we paid for our. Okay, so 4,100 times 39 is what we want here. 4,100 times 39 is 159,900, and that is a cash payment. Okay, now this last one, we're going to pay dividends. Okay, we're going to pay dividends. By the way, this is a cash payment. This is a cash payment also. So when you pay cash dividends, down goes cash, and it's in the financing section. Okay, we're paying $180 a share. Now be careful, $180 a share of dividends. $180, not $180, $1.80 dividends per share of outstanding. Okay, so you kind of got to understand that outstanding shares are issued minus treasury stock. Okay, so we can't pay ourselves. So how much did we issue? Okay, we issued 23,000 shares, but we've got 4,000 of our own shares. Well, we're not going to pay ourselves. Okay, so we're going to pay 19,000. There are 19,000 shares, and we're going to take that times $1.80. Okay, so we're going to pay out $34,200 to shares outstanding. Okay, shares outstanding. So there you have it. Okay, that is some different pieces there that go into the cash flow statement, how much each one of those affect cash. Sometimes it takes a little calculating. Okay, the last two are chapter 14. Okay, chapter 14. So we've got a horizontal analysis, right? It says prepare a comparative income statement with horizontal analysis. So that is going across side to side, indicating the increase or the decrease for the current year when compared with the previous year. All right, so I believe, okay, let me see here if I have, oh, okay. Okay, hold on a second. I got to go back to 14 because I have a horizontal analysis in a spreadsheet. Yep. And it just makes it a little easier for me. Sorry about that. Okay, here it is. Let me just grab this. So you need to know the difference between horizontal and vertical. Remember, horizontal is side to side. Okay, so I'm going to put these in. All right, so okay, so let me put these in. This is an income statement. Remember, how do you find, okay, so let me key this in. Okay. Okay, so the increase, remember, this is the year before, this is the current year. So the amount of the increase is 400,000, and that is a 20% change. That's a 20% increase. Remember, the change percentage is new minus old divided by old. Okay, let's keep going. So the cost of goods sold, and I'm going to put this in as a negative. So that, okay. Okay, just put these in first. Okay, and we need to do the math here to make sure I got it. Yep. So once you have a formula in, you can highlight it with the black plus sign. There you go. All right. And then selling expenses. Okay. And then we have administrative expenses. Oop. Make sure you put in your numbers. Okay. And then we want to add the total operating expenses, and that's these two here. So we don't want it to go all the way up. Yeah, just those. So we're making that match. And then we're bringing in, there's the total operating expenses. Here's the income. Now we've got a calculation here. So we're going to take the gross profit and subtract the total operating expenses. All right. And then income tax expense. So we're putting that in as a negative. Doing the math here. And this is the net income, I think. Did I miss something? Yes, I did. Income before, wait, nope. The income tax expense. Now I need to subtract. Okay. Nope. Something's wrong here. Just a minute. Okay, income. Yeah. I don't know. Let me do this again. Okay, so we want income before income tax expense. So we want gross profit equals gross profit. Oh, let's add. Oh, go. There it is. Okay, so we want that here. And then we just want, that's supposed to be it. Okay, so I think this looks like this one. So we don't need this. Okay, so now let's put in the amounts. So we want increase or decrease. So we increase sales by 400,000, right? Okay, and they want us to, okay, and then we increased so if you increase sales, the cost of what you sold naturally will go up, right? But notice it's not going up quite as much. All right, so this becomes 20%, and they want that in there as 1 decimal. So be careful. Okay, and then we want 74,000. And remember, we're doing the percent change here. So it went up 26.4%. So a 20% increase in sales, and we didn't go up quite as fast. So we're doing some good cost cutting there. Selling expenses. Okay, the selling expenses increased by 26,000. And that is 21.0. And administrative expenses increased by 15,000. And that is 15.0. And then we have 41,000, 18.3. And if I have any of these wrong, we'll see what they are. 33,000 is an increase in the income before income taxes, 58.9. And then the income tax went up 13,100, 58.5, and then the increase of the net income is 19,900. All right, so it may seem odd that you actually increase sales by 20%, but we also did not increase cost of goods sold at the same rate. So you're getting you're making more here. And notice that this is 21%, this is 15%. So the net income for Winthrop Company increased between years. This income was the combined result of an increase in sales and a lower percentage increase in cost of goods sold. So what I'm trying to say is this cost of goods sold, if everything was equal from the year last year, that ought to be a 20% increase and that ought to be a 20% increase. But we've got a 1% difference. So we're getting better costs. Okay. The cost of goods sold, hang on. This increase was the combined result of an increase in sales and a lower percentage increase in cost of goods sold. The cost of goods sold increased at a slower rate than the increase in sales, thus causing the percentage increase in gross profit to be greater than the percent increase. Look at gross profit. Gross profit is 26.4. So you're getting more gross profit, even a bigger percentage than the sales that you did. Okay, so once again, you have to calculate the increase or the decrease and put it here, and then the percentage. Okay, last one. We had all those ratios and all those calculations. So this one, we're going to do the current ratios, just so that you remember what they are. Current ratios. So just a second. Current measures here it is, the liquidity, right? We're going to do these first three here. We've got current assets minus current liability, or current liabilities get subtracted from current assets. Then we have current assets over current liabilities. Then we have quick assets over current liabilities. So let's see what we can do. All right, let's put in what they're giving us here. Okay, so we should be able to do this without too much. We'll see what happens here. All right, so cash is, okay, determine for each year. Oh, each year. All right, we're going to do this twice. So we're going to do the current year on the top. And then we'll do the okay, let's go ahead and put in what we have here. So we have the current year on the top. Okay, so 389. We have inventories. Okay, and then I need to make another, let me put a couple more here. Okay, this is going to be prepaid expenses. Now we have total current assets. Okay, we can add all these together. Yep. There's going to be our total current assets. So then we have our current liabilities. of accounts payable and accrued liabilities. So hold on, let me push this down. Okay, so we have accounts payable and accrued. Remember, the word accrued means that you've recognized an expense in the right accounting period. All right, so let's do both of these, 301,600 and 218,400. Now remember, we don't know what the equity is, but we know that it has to equal. No, we don't know the rest of our assets, so don't try to do a balance sheet here. I'm going to add these two amounts together because we're going to need current. So this is total current liabilities. And we're going to add these two together. All right. And then, okay, we need to do this again. Okay, this is going to be current year. And then we'll do previous year. Okay, previous year. Oop, hold on. Just a minute, just a minute. Okay, we do want this. Just got to get the right one out of here. There. Okay. All right. So now the previous year. Two five two. Marketable securities, accounts receivable, inventory, prepaid expenses. Okay, so that matches. And then the liabilities for that. All right, so we should match up now. So the working capital for each is going to be this number minus this number. Okay, so working capital, we'll just go down here a few more. Okay, working capital is assets, total current assets minus total current liabilities. So 728,000. Okay, and then the current ratio. Okay, and just so you'll know how this number got created, equals. Okay, let me put that equals 1,248,123 minus 520,123. Yep, that's how that got there. Okay, the current ratio is going to equal 1,248,000 divided by 520,000. That one's going to, no, I just want that to show because I want you to be able to see it. So we'll put that little there. Okay, so then let's do the math on this one. Okay, current ratio. Whoop. It's a division problem. Most of these are division problem. Yes. Whoop. Hang on a minute. I don't know how I got that in there. Okay. So 2, and we want to see if it's a whole number. So 2, all right. So current year is 728,000. The current ratio, which means that for every dollar of current assets for every dollar of liabilities that you have $2.40 in assets. So the higher the number, the better. Working capital, the higher the number, the better. Okay, and then the quick ratio. Okay, just a second. Okay, then the quick ratio. So you got to know what the quick assets are. Quick ratio. So I'm going to do equals sum, open parentheses. I'm just going to add up the first 3, close parentheses, and divide by total current liabilities. Okay, so this is going to get a number similar to this one. And we want to increase, there it is, 1.7. Okay, let's do the rest here. Let me get this for the previous year. Okay, so working capital equals total current assets minus current liabilities. So that is $855 minus, okay, there's that one. Current ratio then is your current assets divided by your current liabilities, 190. And then this one is, okay, so, wait a minute. Yeah, we're right here. Okay, let me put this in so you can see what I calculated. So once again, it is current assets divided by, okay, and then this is going to be equals the sum. And we're just going to add up the first 3, cash, marketable securities, and accounts receivable. Be careful in case you get a question in multiple choice. Which of these are known as the quick assets? It's good to know that. Okay. So it looks like we've got, okay, so working capital for the previous year. Yes, I'm still here. Previous year, we're almost done. 405,000. So current ratio last year was 1.90, and then quick ratio was 1.40. So it looks to me like all of these have gone up from the previous year. The liquidity, remember liquidity is close to cash, so you can pay bills, has improved from the preceding year because all of these have gone up. The working capital, current ratio, and quick ratio have all increased. These changes are the result of an increase in current assets relative to current liabilities. Yep. So this went up much more. There's a difference between current assets here, quite a bit bigger difference here, and then liabilities here. So that's it, folks. Okay, I am going to say goodbye for now. And we will, let me just save this. Okay. All right. We do another video here. Okay. See if I can quit sharing here. Okay, we'll see you on the next video. Thanks for your hard work.